Good morning, and thank you for joining Armanino. We are going to cover the cost of ignoring new revenue recognition standards today. At the end of the webinar and within 48 hours, we will send you a link to the recording and a copy of our slide deck. So I want to just review for you how to use your webinar pane. In the upper right-hand corner of your screen, you'll see an orange arrow. If you'd like to ask a question of our presenter, you can hit that orange arrow to expand the box, type it in, and we will answer questions if there's time allowed at the end. If not, we will get back to you via email. Okay, and also to use your audio settings, please make sure that you select the correct option. If you're listening through your computer, select the computer audio button. If you've called in, use the phone call button. And I do want to let you know this is a half-an-hour webinar, so it does not qualify for CPE. All right, our presenter today is John Dunnican. He's a partner here at Armanino and has over 30 years of financial executive operations and consulting experience. He's had many positions in industry as CFO, VP of Finance, Treasurer and Controller. And John really focuses on kind of all the management, financial, and operational skills needed to run your business. And he has great experience with these new revenue recognition standards. Today, we are going to examine a prototype revenue recognition gap assessment. We're going to identify an organization's holistic risks from the departmental level to the valuation of the entire company. And we're going to just, with our examples of revenue recognition challenges, have you evaluate how prepared your internal team is to handle the requirements and the impacts of the new regulations. Okay, we're going to start off with a polling question. This will just take a moment for you to answer. But we wanted to find out, how prepared are you for the new rules? So you can check all the boxes that apply. You're just starting to think about it. You've done a gap assessment. You've got a team in place. You've got your software solution in place. And you've got a transition strategy. So please go ahead and weigh in with your votes. And we're going to give you just a couple more seconds to do that. Let us know how prepared you are. We're glad that you're on this call because with the new rules coming into effect for private companies on January 1st, 2019, now is the time to get ready. Okay, we're going to go ahead and close that poll and let you know that it looks like the majority of you are just starting to think about and get ready. So today's webinar is a great way to do that. And with that, I'm going to hand it over to John.
Thank you, Mary. And good morning, everyone, and good afternoon to those of you on the eastern half of the United States. As Mary said, we're going to start with just kind of a couple of real basics here. As Mary said, that the go live for private companies is January 19. Public companies was January 18. So if you happen to work for a public company, I hope you've already adopted the standard. If not, we probably need to have a conversation pretty quickly because you're really behind the curve. Just starting to think about it from the survey results is not very surprising for a lot of private companies. A lot of private companies are wrapping up their 2017 year ends, and now they're just beginning to think about next year and how they want to move forward. If you are pre-revenue or really just getting started, you would be definitely want to think about early adopting, which is to say adopt now in 2018, only because then you don't have to restate and kind of double track your revenue. So kind of again, just kind of covering the basics. The standard identifies really 5 steps to go through for revenue recognition. And these, quite honestly, are not very different than probably what you've been doing all along. The 5 steps, obviously, first, make sure you have a contract with the customer. Separate the contract's commitments. Under 606, they talk about them as performance obligations. Under the 605 and the various standards before, it's essentially the same thing, though. There are some differences, which I'll talk about in some of the examples. But we do need to identify each of the contract commitments if there's multiple elements in the contract. Identify the transaction price. Typically, it's almost always the contract price. That's usually pretty straightforward. Allocating the purchase price to each of the performance obligations is where things really get interesting, and that's where a lot of the changes have occurred. And then when revenue is recognized, but with the new standard, there are some differences in how that and how and when that happens. So let's talk a little bit about some of the costs of the new revenue recognition standard. So first, I mean, it's important to note that the total amount of revenue to be recognized is not going to change. You know, you're still going to recognize the total revenue of the contract. However, the timing could be very different. Interestingly, particularly for accounting standards, for those that have been doing this a while, it almost never happens the accounting standard gives you revenue earlier. They always seem to be pushing it out or taking it away. But the new standard actually in many companies is going to drive earlier revenue recognition. I was looking at Microsoft early adopted the revenue recognition standard for their fiscal year starting July 1, 2017. So they're kind of wrapping up their second quarter now. But for their first quarter, which 10Q, which they released in September for September 30th, they actually, as a result of adopting a new standard, now they also adopted the lease standard at the same time because for them it's interrelated. But they previously reported 60 cents per share of earnings. As a result of the new adoption of the new standard, it actually went to 72 cents per share because their revenue increased from 20.4 million to basically 22 million. So I picked up $1.5 million worth of revenue in the quarter. Excuse me, $1 billion, I should be saying, not $1 million. $1.5 billion of revenue in the quarter as a result of adopting the new standards. So that's not something you run into very often, that the standards actually give you more revenue. The guidance, one of the other big changes is the guidance does require you to estimate variable considerations such as sales incentive, discounts, and warranties. A lot of the things that under the old standard would have been delayed until they were resolved, but now they actually get recognized up front. Some of the examples we have will highlight that a little more. And I want to start with one of the examples here. I should say these examples are pretty much simplified for webinar purposes, and they just kind of highlight how this works and some of the impacts are going to be. So things are not always necessarily quite this simple, but I thought that these are some good examples of what we've seen companies doing, some of our clients as we've done this, to give you some idea of what some of the implications might be. And we're going to start with kind of a software industry example here. A lot of the clients a lot of the folks on this call I know are from the technology industry, but we've got a vendor that's selling perpetual software licenses and 2 years of support. Fairly typical scenario for a lot of companies. You know, they make upgrades for the clients if and when they're available. So there's no firm commitment to do so, but whenever they're available, they do get them as part of the support package. We're going to assume a sales price of $10,000 per unit. And just for the example, we're going to say this client does not have VSOE. So they never established VSOE for revenue recognition. So a couple of notes here under the new standard. Well, first is that under the new standard, VSOE goes away. So for all of you out there who've been struggling because you've never had VSOE, you've never been able to establish that, the good news is you no longer have to worry about that because the standard has removed that. That said, the revenue still needs to be allocated based on standalone selling price. And the standard has some guidance to do that, to drive that. And it essentially has 4 levels of standalone selling price and how you do that. The first is in the preferred method, and these are in order of how the standard wants you to use them, or they recommend adopting them. The first is what they call observable price. And essentially that is the price at which you would sell the products on a standalone basis to your customers. And if that sounds a whole lot like VSOE, it really is very much like VSOE. And essentially it's what price are you selling the products to your customers at? The second option, if you don't have that as an observable, if you don't have good observable evidence, is what they call adjusted market assessment. And essentially that's looking at what the competitors are doing, what the market is doing, to estimate what the selling price would be of your product, based on what other customers are selling it at. Reality is, for most of you out there, I'm sure you don't, it's very hard to get evidence, detailed evidence on what your customers are selling their products for, similar products to yours. That information is generally not available unless you happen to be selling something that's very much a commodity. That works well in the commodity type industries where we have very much published prices. But for most of us out there, most of our clients, that information is not really readily available. So it's pretty hard to do that, absent being a very commodity-driven business. The third option is expected costs plus margin. So if you don't have observable prices, what you then have to do is say, what's it going to cost to deliver this product or this service, and what would be a normal margin or expected margin on that, and then use that as the basis for determining the individual standalone selling prices. This is very different than the old standards would have allowed, because this is very much requiring you to do a lot of estimation, a lot of guesswork, and without any kind of real solid evidence. It is the kind of thing, if you think about, what type of evidence you're going to need for your auditors, this is going to be a real challenge to kind of document how you do that. And the final method, of course, is the residual approach. If you have one item that you don't have information for, either because prices that you've sold it at vary tremendously, or you've never priced the product, you are allowed to use a residual method. Under the current standard, that's only allowed for certain software cases, but under the new standard, you are allowed to use it for really any of the deliverables, as long as kind of a last resort, and it very much is a last resort. So let's take a look at our example here and how this might play out under 605 and 606. 605 is on the right. Most of you probably know this already. It's probably, if you have a scenario like this is how you would do it. You essentially have $10,000 deferred revenue. You're going to recognize it over 24 months because that's a service period. You didn't have VSOE to allocate the price, so you basically just end up deferring everything and amortizing it over the contract period. Under the new standard, though, you really need to look at each of these deliverables separately. And you are required to allocate the price to the elements. So you can't just say, well, I don't have license revenue. I don't know what the upgrades are worth. So I'm just going to really bundle it all and amortize it out. That's really no longer an option for you. So you really do need to then sit down and really do the analysis and determine what the pricing is. The other thing you may have noticed here, which is very different, is that upgrades need to be recognized separately. Back in my days as a CFO, I love the if and when available scenario for revenue recognition, because essentially you could ignore it. I didn't have a firm commitment to do anything with it. I didn't have a contract to do it. If I never did it, I didn't have a penalty. So for revenue purposes, I could ignore it. It wasn't a firm commitment. However, under the new standard, they call this out very specifically as something you do need to recognize. You can no longer just say it's, I don't have a commitment, I don't have to do it. The old if and when available, you do need to actually value that and determine what the value of that is. Now, part of that is, of course, looking at, in fact, do you do upgrades? And if the answer is yes, you really do upgrade, you very well may need to put a value on that. So in this scenario, we're going to assume that we've done the analysis, licenses revenue, and we allocated it, as you can see here. License is $3,000 is recognized up front. The support is $5,000. That's still amortized over 24 months because that's a delivery period. And then the upgrades are recognized when they're actually delivered. So when you do the upgrades, that's when you need to recognize that revenue. Okay, moving on here, we had a few other quick ones we want to go through pretty quickly. We call this is real estate, but this is essentially any contract where you might be building an asset for someone. This gets into the whole question of probabilities and variable consideration for contracts. And essentially, you've got a $100,000 asset you're building. There's a $50,000 performance bonus that has a penalty associated with it for being late. And essentially, based on your history, you know that your probabilities, you can see here, 30% of being on time, 60% being 1 week late, and 10% being 2 weeks late. And you've got experience to really kind of justify what those are. So under the new standard, what do you do with that? Well, under the 605, the current standard, you really didn't do anything with it. You'd wait until you until you resolve the issue and you know exactly what the bonus is, and then you would recognize it. However, under the new standard, it's different. The new standard, you would recognize it up front if you've got history to actually determine it. And if management anticipates being a week late based on their history, they're going to get a $45,000 bonus. So that could potentially be recognized up front. And then, so you've got a very big difference in the timing here. Of course, once you know if the actual delivery is going to be different, you would adjust that $45,000 either up or down. So you could actually have a little bit of a hit later on if you find out you're going to be 2 weeks late, or you'd have an additional pickup if you find out you're going to be delivered on time. So that's where you can see that the new standard is very, very different. Another one, back to the tech manufacturing scenario. You've got customer sells $20,000 worth of products. Customers have a year to return the product if it doesn't meet their needs. The customer doesn't have a sales return history, but does not expect returns to exceed more than 10% of sales. So how does this play out under the new standard? Well, under 605, essentially the revenue would be deferred because you can't recognize the revenue until the return right lapses under the current standard, because you don't have a real way, you don't have a history to determine what that is. It's a little different than if you say you were a real retailer where you've got, you've got a long history of a 5% return rate. Then you recognize net of returns, but here that's not true, and they only have they don't have that kind of history to do that. So you would recognize the revenue when the return right expires, and that's when you would recognize the revenue. It would all be deferred. However, in the new standard, it would be different. You could still recognize it up front, despite the fact you don't have the history. You'd record not all of the revenue, because you have a 10% expected return. You would record a liability for that potential $2,000, 10%, and again you would true it up when the actual return right expires. You either recognize the $2,000, or you would have to do a refund for the 10%, or if it wasn't 10%, with some other number, you would adjust accordingly. I'm going to do a life science. This one gets a little more interesting here, but we have a lot of life science clients I know on the phone, so I wanted to keep this in here. Company A grants a right to use a license to Company B. Company A is also going to perform some R&D on the intellectual property to come for Company B. In exchange, Company A is going to receive an upfront payment of $20 million, a per hour rate for the R&D services performed, and a milestone payment of $50 million if they get regulatory approval. These types of arrangements are fairly common in the life science industry, where you've got a very high risk and very high development costs. That companies will do these types of arrangements, and they'll work with other companies to do the development. So this requires a little extra analysis. So I've got an extra page in here. And essentially, there are two performance obligations here. You can see them up there: the right to use license and the performance of the R&D services. Company A estimates that the R&D services will be about $10 million under the contract. So you can see that amount there. And as is typical, at least at the beginning, the regulatory approval is considered unlikely. As I'm sure you're aware, a lot of these R&D projects, never get regulatory approval. They never go that far. So we're going to assume that the regulatory approval is unlikely. So they're not going to do anything with the $50 million at this point. So what are they? So the total transaction value is $30 million, as you can see. It's the $20 million up front and a $10 million for R&D. So what you've got at the bottom there is essentially an allocation of how those prices are being allocated. We're going to estimate that the standalone estimated cost for license is $30 million. The R&D services is $20 million. So you can see there is a very simple kind of calculation of how you would allocate, based on the standalone selling price of $50 million, the service costs of $10 million and the transaction of $20 million. And it gets allocated to the license of $18 million and the R&D of $12 million. So that's essentially what's going on here. So what does that mean from an accounting point of view then after you do that analysis? So on the right, under 605, you would essentially, the $20 million would be probably recognized up front when it's the right to use license of $20 million. The R&D work would be recognized as delivered. It'd probably be billed on an hourly basis, but over time it would be the $10 million of revenue you'd recognize over time. However, under the 606 standard, because you need to allocate that revenue across both deliverables, you end up with a somewhat different scenario. In this case, less upfront, because we allocated $18 million to the right to use license. So the initial cash is still $20 million. The revenue is 18 recognized up front, and $2 million goes to deferred revenue. And then as the R&D is delivered and that gets paid out, the deferred revenue is recognized over time, proportionally to how it's delivered. And eventually you recognize the full $12 million as those services are delivered. So this is a case where the timing is lower and gets spread out further. And finally, I want to do one quick nonprofit scenario here. Because a lot of nonprofits are impacted by the new standard, because a lot of them do have revenue, and very often you see membership in programs for a lot of nonprofits, particularly things like museums and symphonies and the like will have membership, and so we're going to assume that there's $60 in annual dues to be a member. You can see that the various items here that we've got. There's a newsletter. There's maybe access to the archives. There's a free admission and some parking that you get for free included. So for your $60 in membership, you get $75 worth of value of these various services that the museum or the nonprofit provides. So again, just by way of a little quick allocation here, because you need to recognize the $60 across the 4 elements. And you can see how you see a little simple math there, how that's allocated to each of those 4 elements based on the proportion of the revenue. So what happens with the revenue then? On the right, under the current standard, the $60 would be basically amortized over the 1-year membership. So you recognize $5 per month over the period. Under the new standard, though, it's somewhat different. All of the revenue is still deferred, but the timing is very different. The newsletter would be recognized monthly at $2 a month, because the total is $12. The deferred revenue for the other pieces would each be recognized as they're used. So as the members you access the archives, as they use their free admission, as they use their parking, each of those elements would be recognized separately, as opposed to the current standard where you very well may spread it out over 12 months. So those are just some ideas of how the new standard might impact you, depending on your industry, and how you operate and what you do. So what's the question then is what should you do now? If you're beginning to think about this, what's your next step? How should you approach this is what can be a real challenge here around the 606. What we recommend, and what the actually AICPA recommends as part of their implementation guidance or their adoption guidance for 606, is really to start with a detailed assessment and really understand, look at your current standard, and this is what we do for our clients, is really do that gap analysis. Look at your current revenue recognition process and methodology, and how is it going to be impacted? What are the differences? And what's the potential exposure to the company? And what are the areas that are affected by the new standard, or what needs to change? And I want to stop here for a second and just kind of make a point that you need to think of 606 as way beyond an accounting change. Clearly, it's an accounting change, but it really impacts a lot of other parts of the business if you think about the impacts of changing revenue. Clearly, it's going to impact the accounting department, but you also need to think about what is it going to impact on your systems. However you're doing revenue recognition today, whether you're just doing it in Excel, or if you have a revenue standard, a contract system you're using that's recognized revenue, that's going to need to be updated for the new standard. If you're using Salesforce or Microsoft CRM to track your various contract elements, that's going to need to be changed. So you need to think about all of the implications of how that's going to flow through all of your systems. We have up here, there's a point about being budgeting systems. However you're doing your budgeting and forecasting, that needs to change as well, because your revenue is now going to be different. So whether you're doing it in Excel or using a program like Adaptive Insights, you need to think about how that's going to be changed. Beyond that, you need to think about the impact on your sales, possibly on your commissions, and how your sales reps are paid. Because if it's in any way tied to recognition, that's going to be very, very different. You also need to think about what it means for your investors. If you've got VCs, private equity groups, or however you're funded, the revenue is going to change. Your reporting is going to change. You want to start making sure that those investors understand the changes, because your revenue is going to be different going forward. It could be much lumpier than it's been, particularly if you're on that very simple amortization model. Your revenue is going to start getting a lot lumpier, and we know investors don't like lumpy revenue. You also want to be thinking about things like if you have bank covenants, debt covenants could also need to be changed and updated. So you need to start thinking about the impact on those as well, and possibly meeting with banks and investors to talk about any types of covenants or requirements you have around revenue, around net income, or EBITDA, or any of those types of measures that are going to be very, very different. You also want to maybe start thinking about terms and conditions of your contracts. You want to start thinking about how those need to change. And that's essentially where we really kind of work with our clients to try and do that, to do this gap assessment, really identify what all those changes are, help you work through those. And then, of course, we also help our clients with the actual implementation of 606, going through all the existing contracts. Maybe you've got a few dozen contracts, but maybe you have thousands of contracts that need to be reviewed and restated for the new standard. Because any contracts you have that are even this year in 17, this year in 18, as you roll forward into 19, part of the requirement of the adoption is to either restate. Full retrospective means you need to restate 18 to reflect a new standard, or you can do the modified retrospective, in which case you need to just take the impact of the new adoption into your retained earnings. But either way, you need to look at all of your historic contracts as well and determine what that impact is. So that can be a lot of work, and you really want to get ahead of that and kind of put together a project plan now to really start addressing a lot of those issues.
Great. Thank you, John. You covered a lot of ground in a short amount of time, so thank you for that. So during this webinar, we've covered a prototype revenue recognition gap assessment between the current and future states. We also identified some of the holistic risks as they pertain to sales and commissions and your contracts and your funding organizations. So from the departmental level, such as legal, sales, internal controls, and finance, and to the valuation of your entire company. So all of these will be impacted by ASC 606. We got a few questions. We're not able to answer all of them, but two that we can. The first is someone asked if this webinar will be archived, and yes, you'll receive an email with a link to the recording within the next 48 hours. And then there's one I think that, John, you might be able to answer for the audience, and that is, aren't contracts 12 months or less excluded from this this new revenue recognition standard?
No, they're not. They're only excluded to the extent that they fall within the same year. They might be, but to the extent they break over a year, you would need to look at the impact of those contracts on the financial reporting, how it's going to impact deferred revenue as of the contract date. So they're not necessarily excluded. What is excluded, which we didn't really talk about today, is commissions. Commission accounting is quite a bit different under 606 standard. Essentially, if you have a multi-year contract, commissions need to be capitalized and amortized over the life of the contract, and that is excluded. There is a 12-month exclusion from that. But the contracts are not necessarily excluded just because they're under 12 months. One other quick question that I see up there. So there's a question about is there guidance suggesting over what period to recognize if and when upgrades are available, and how that works on a perpetual license model? And essentially, the answer to that is not unfortunately very simple. It kind of depends on two things. Is typically on a perpetual license model, there is a period over which the upgrades are made available, and it's usually tied to the service contract. Typically, clients will have a service contract of maybe 1 year, 3 years, 5 years, whatever it is, and the upgrades are available over that period. And that's the period over which we'd be talking about. So they may have a perpetual license that they keep the use license forever, but typically the service period, or the period of which they get upgrades, is limited. Now, I want to make the distinction here between upgrades and updates. Updates are what you get from, like from Microsoft all the time and other vendors where they're doing the bug fixes and the security fixes and those kinds of things. Those are often just made available, generally available for free, and they generally are not impacted by the new standard because they are free. These are more the upgrades where you're moving like from version 2 to version 3, kind of the new functionality, new features, kind of those types of things is what we're talking about here. And if I've got about 30 seconds left, and what constitutes, along the same lines, what constitutes delivery of the upgrade? It depends. For most companies, it's when it's made available to the customer. If the customer just downloads it and does it themselves, it's when you essentially would put it on the website, on your website, and the customer can go take it. That would be when it's delivered. If you actually have to deliver to the customer, then it would be when that actually happens and the customer actually receives it. So it's a little bit dependent on how you operate as to how it's recognized.
Okay, well, thank you very much. And if you have further questions, you can email John directly at john.dunnican@armaninollp.com. We thank you for joining us today, and we look forward to having you on another webinar. Thank you. Bye.